Welcome to the webinar. My name is Marty Schenkman, and we have what will no doubt be a great and very informative webinar with Steve Gorin, who I'll introduce in a second, presenting on some really practical topics on business planning, intrafamily business transactions, and so on. Before we get started, let's just get a quick word from our couple of sponsors. And just before we start that, on the handout tab on the web console are three documents. One is a PDF of a handout that Steve Gorin prepared on the topic. Before you hit the print button, it's about 190 pages. Steve created a really incredible document that's really very valuable and informative. Just be mindful how long it is before you hit print. The PowerPoint appears as two PDFs, and this is what I've always done. So you have one slide per page if you prefer that format, and you have a second one that is 3 slides per page if you print that. If you have any problem downloading everything, it's all going to be posted within a couple of days to schenkmanlaw.com/webinars. And in the webinar tab of the Schenkman Law website, we'll have the recording and all the materials yet again if you miss it. Vanessa, do you want to give a quick plug for Interactive?
Yeah, absolutely. Thank you, Marty. Thanks so much to Marty and Steve for presenting this webinar on a topic of continued importance for estate planning, estate planners and their clients. Just wanted to say thank you for allowing us the opportunity to sponsor. And if any of you would like additional information on Interactive Legal or our resources for elder law and estate planning attorneys, please don't hesitate to contact us at using the information that you see on your screen, or visit our website at interactivelegals.com. Thank you.
Thanks, Vanessa. Peak Trust was one of our other sponsors, and they could not be with us. So just on behalf of Peak, their contact data is on slide 5. Peak is a full-service trust company in Alaska and Nevada, and you can contact them at the information there. The next slide is from the American Brain Foundation, a wonderful charity that I'm personally very active in, and something that we're going to try to do on as many webinars as we can in the future is feature different charities. So if you have a charity that you're active in and would like us to plug, please let me know. Comments?
Hi, this is Lisa Dahlberg, and I work for the American Brain Foundation. Thank you so much, Marty, for letting us have just a moment here to tell you about us. I'd like to tell you all a little bit about the organization. So we bring researchers and donors together to cure brain disease, and we promote and invest in research across this whole spectrum of brain disease. Our belief, which is backed by cutting-edge brain science, is that when we cure one brain disease, we will cure many because all the structures in the brain are related. So if you or a client are interested in learning more about joining us, please get in touch with me, and thank you so much.
Thank you, Lisa. Steve, it's all yours.
Thank you very much, Marty. It's a pleasure to be here. So we're going to be talking about planning for business exits from C corporations, and we'll talk about the sale of C Corp stock, this Code Section 1202 exclusion, which some people have touted as one of the best tax shelters that's out there. I'm going to really talk about what all is involved in using it, and also about how it really is not necessarily such a great advantage compared to selling S Corp stock or partnership interest. So we'll get into that issue, and then we'll talk about just general exit strategies, and we'll also talk about some intrafamily sale issues. So let's actually go ahead. Yes.
Steve, before we go on, I want to give a shameless plug for you. For those of you who don't know Steve, he's really one of the more brilliant practitioners in the country. And I can tell you that Steve does consult with other advisors. And I myself, when I get some esoteric, hairy client matters, have often consulted with Steve. And he's really not only brilliant, but a gentleman to work with. So there's a shameless plug for you, Steve.
Thank you so much for Marty. I very much enjoy working with you, and I appreciate your generosity in sponsoring this webinar. So the first few slides that I have here are talking about annual charitable contribution for businesses, and there were a lot of developments in 2019, and I just wanted to leave those in there just for you to look at some general ideas. So I'm not going to spend time going through those because it's going to take a long time to go through the 1202. So they're just for your perusal as listeners, and again, we do have charities that are being helped here, and I really encourage people to read through these things, which are talking about the effect of being able to deduct charitable contributions in light of the idea that we have some state tax credits for charitable contributions. So basically, slide 10 goes through that, and as well as slide 11, and slide 12 talks about some relief that are given for certain business donations, and slide 12 and 13 talks about those as well. So we're going to go ahead and skip over to slide 14 and get into the meat of it with the sale of the C Corp stock. So Code Section 1202 has an exclusion, and as I mentioned, there are other opportunities when you dispose of C Corp taxation, and we're going to go through the different types of exit. So going on to slide 15, the amount of the exclusion. We'll talk about the amount of exclusion. We will talk about the stock issuance requirements to see whether your stock would qualify just on the way you acquired it. And we'll talk about which businesses qualify, and we'll talk about the effect of 1202 in business structure. So which structures are okay and which structures might disqualify you from 1202. So going on to slide 16, so the amount of the code section 1202 exclusion is the greater of $10 million on a cumulative basis, or 10 times the adjusted basis of stock sold during the taxable year. Now this $10 million, it says $5 million if you're married filing separately. Then the question is, well, what if you have a married couple and they each have stock? Do they each get a $10 million exclusion for a total of $20 million? And they might. You got to look at the statute and see what you think. And that 10 times the adjusted basis of stock sold during the year, we will get into a little bit later in the webinar that adjusted basis in that slide, even though that's what the statute says, there's other parts in the statute that define it as something other than adjusted basis. So we'll get through that as well. So slide 17. So the stock that can qualify for this exclusion must be original issue stock. So the corporation itself must have issued it to the seller, and the seller has to hold it for 5 years. So purchase stock does not count. So let's suppose that Marty starts a C corporation, and that C corporation qualifies, and Marty go ahead and after 6 years he sells the stock, and Marty gets an exclusion on the sale of that stock. So now I buy that stock. So when I bought the stock, I bought it from Marty. The corporation did not issue it to me. I bought it from him. Marty will get the exclusion when he sells the stock, but when I sell it, I don't get the exclusion because it wasn't issued to me. It was issued to Marty, and then it was sold to me. Now, could we get cute? What if Marty has 99% of his stock gets redeemed by the corporation, and then he sells me 1 share of stock, and then the corporation turns around and issues me 99 shares. So now does that mean that 99% of what I have is original issue so I can get the exclusion? Well, no, there's an anti-abuse rule in there, and it doesn't even look to see whether you try to abuse it or not. If Marty's stock is redeemed within 2 years of issuing the stock to me, then they get stepped together, and it's counted as if I purchased that from Marty. So we can't do an end around. So that's an issue. Now there's one little nuance there in that fourth bullet point. So let's suppose that I were an employee of the corporation, and Marty is the owner, and being a really nice employer, he says, Steve, I want to incentivize you. I want to give you stock in recognition of your service. And then not only will you feel rewarded from that, but now you have a piece of the pie, and going forward, you'll have a direct ownership in the business, and you'll be more incentivized to do a better job. So if Marty gave me the stock and as compensation for my services, that's not really a gift to me. That really is due to my employee relationship, because Marty's trying to incentivize me and trying to reward me for the work I've done. So actually, if he gives me the stock directly, the regulations under Code Section 83 say that he is deemed to have contributed that stock to the corporation, and the corporation then issued that stock to me. Now notice I said that he's deemed to have contributed it. He hasn't been redeemed from the stock, so the redemption anti-abuse rule doesn't apply. He simply has contributed that to the corporation, and then the stock is originally issued to me. So that stock does count. Okay, going on to the next slide, slide 18. There's some additional exceptions, and again, if the seller is retiring or terminating service, then that also can count as good stock. Here's another bullet point, which is really one of the most powerful things: passing by reason of death, gift, or trust distribution, or bought within 3 years and 9 months from the date of death. But let's think about this passing by reason of death, or a gift, or a trust distribution. So let's move on to slide 19 and talk about how powerful that can be. So you may recall back when we were on slide 16 that you had this greater of $10 million or 10 times adjusted basis. So this $10 million exclusion, you can multiply it by making a gift of the stock. So if I were the owner of the stock and I made a gift to my son and a gift to my daughter, so each of them can have a $10 million exclusion. So I can have a $10 million exclusion, my son can have a $10 million exclusion, my daughter can have a $10 million exclusion. So we could have $30 million worth of exclusions. And the holding period tax. So let's suppose that I've held my stock for 5 years. I'm on the verge of selling my company. So I want to give $10 million to my son and $10 million to my daughter. That's fine. We can get $30 million of exclusions. Now, of course, Marty would then put on his estate and gift tax lawyer hat, and he would say, wait a minute, Steve, if you give $10 million to your son and $10 million to your daughter, that's $20 million of gifts. Maybe I can split gifts with my wife, and then we'll be okay. But we just need to be careful of that to make sure that we have enough lifetime gift exemption. Now, one option that you could do is you could consider in that third bullet point making a gift to an incomplete gift non-grantor trust. So I can do this incomplete gift non-grantor trust for my son and another incomplete gift non-grantor trust for my daughter. So what is this incomplete gift non-grantor trust? So non-grantor trust, that means it's a trust that pays its own taxes. Incomplete gift means when I made a gift to the trust, it did not count as a completed gift for gift tax purposes. So for gift tax purposes, I haven't really saved anything by making a gift to this trust. I'm just trying to get a different taxpayer here. So there is such thing as an incomplete gift non-grantor trust, and there are lots of private letter rulings out there for when people have done those. A lot of times they're done to save state income taxes. In this case, we don't have to worry about, we're not really doing this to save income taxes. We're doing it to multiply our exclusion, the $10 million exclusion. So you might want to consider doing that. So now, of course, incomplete gift non-grantor trust, there's an acronym for that, or ING, I-N-G, or ING. So a very popular one has been in Delaware, that would be a DING. Now, if you build in asset protection feature to that, then you could have a Delaware incomplete non-grantor trust that's a bankruptcy avoidance trust, BAT, or you could have a DING-BAT. And those of you who remember the great show All in the Family know exactly what that means. So if you are in Missouri, you can create a Missouri Ing trust or a Ming trust. And if you have a perpetual trust, then it might be a Ming dynasty trust and hold 12th century Chinese artifacts. So those are some variations there. So I'm just being tongue-in-cheek with this about the Mings and the Dings. People love to make acronyms. I love to make fun of them. There are also some multiple trust rules. So if I create multiple trusts, if I create a trust for my son and a trust for my daughter, then the IRS might try to say, well, there's all your family members. You know, if your son dies and doesn't leave any descendants, then the remainder goes to the daughter. If the daughter dies, doesn't leave any descendants, the remainder goes to the son. It's really all the same beneficiaries. We're going to treat them all as one trust. So the IRS might try to do that in response to people saying that they were going to be cute with the 2017 tax laws and create multiple trusts. The IRS put out regulations on multiple trusts to try to put some teeth into those rules. There were some proposed regulations which were very, very overreaching. I led a task force of the American College of Trust and Estate Council that made comments on the qualified business income deduction and these multiple trust rules, and we objected very strongly to what the IRS was trying to say. Those proposed regs said, if you even think about taxes, then it's abusive. And we said, hey, that's a little overreaching. You should go back to what the tax law actually says, a principal purpose, which means basically the most important reason. And the IRS relented on it and said, hey, we'll just go back to the statute, whatever that means. You can those are the rules. So what I recommend if people will, if you do create a separate trust for your son and daughter, it would be a good idea to document the non-tax reason. And there's a saying out there. Yes, Marty.
I think if you have separate beneficiaries, that might suffice under 643F to avoid aggregation under the multiple trust rules. So if a son is a beneficiary of one and a daughter of another, that seems pretty easy. The question is, how far can you go with different permutations of family members and beneficiaries to differentiate it? But it could be very powerful to maximize and multiply that $10 million figure.
Yeah, well, you say it should be easy, and common sense would tell you this easy. However, when Congress enacted Code Section 643F, Congress put in some very confusing legislative history, and they conflated a lot of things. And in fact, if you look at that, they even it might be interpreted as including some of the remainder men as beneficiaries. And so that's why I made the comment about if the son died leaving no descendants and the daughter might be a beneficiary, that would be a very common dispositive pattern. If you look at the legislative history, there's some confusion there potentially as to whether those might be added together. So even though it looks like a slam dunk from a common sense viewpoint, and you and I, Marty, and anybody who looks at things from a practical viewpoint would say they're very much separate. Congress decided to confuse things when it created the legislative history, and the proposed regs actually confuse things even more. So even though there's common sense at work, common sense unfortunately doesn't always apply in the tax law when you look at Congress mucking up legislative history. So I do agree on its face, Marty, that a trust for son and trust for daughter are different. But when you look at the legislative history, that will confuse things. So what I recommend doing is let's go back to the saying, you never know somebody till you've shared an inheritance with them, and we've seen lots of siblings fighting crazily. And so when you create that separate trust for son and daughter, rather than having to make sure that the legislative history is not mucking up your interpretation, you put in a sentence or two into your files that says, hey, I don't want the son and daughter to fight, that's why I have separate trust. And that's actually true. That's why most people do have separate trust. So I just go ahead and put that in my notes. It's a sentence or two that's easy to draft. It's not necessarily required, but I would just love to have that evidence if the IRS comes back and attaches using this mucked up legislative history. All right, let's go on to slide 20. Now we're going on, instead of the stock, which businesses qualify. So first of all, the business's gross assets cannot exceed $50 million immediately after the issuance. Also, at all times after the issuance, at least 80% of the value of the corporation's assets has to be used in the active conduct of one or more qualified businesses. And we'll get into what's a qualified business in a minute or two. But notice what this says, at all times after issuance. What does that mean? Does that mean every year, every quarter, every month, every week, every day, every hour, minute, second, nanosecond? What does at all times mean? There is no guidance whatsoever on what at all times means. Now, from a common sense viewpoint, I would probably just look at each taxable year and try to make sure that this qualifies for each taxable year. But that's my common sense. Whether my common sense will rule the day if the IRS audits it, I don't know the answer to that. I think all you can do is take a practical approach. But what I'm saying here is that 1202 does have some significant uncertainties in it. And what kind of records do you need to keep to measure 80% of the value of the corporation's assets used in that business? Maybe 100% is used in that business, so we don't have to worry about it. But we'll get into what's a qualified business in a moment. Now, there is an exception for investment assets. So if you start off and you don't have your business up and running yet, then can you hold on to that cash? Well, there's a 2-year holding period. But one thing you might consider doing is to simply start as an LLC, taxed as a partnership or a sole proprietorship, depending on how many owners you have. Start as an LLC, and then when you have all your money raised, then elect to be taxed as a C corporation. And so you've had the entity in place, you got your money raised, and now we want to turn on the C Corp spigot. And then you know that you don't have to worry about all that holding, that you hold those assets when they weren't actually deployed yet. So that's a practical tip for that. So let's move on to slide 21, and we'll talk about what slides do not qualify. So we actually have a couple of slides here about fields that do not qualify for 1202 treatment. And you'll notice here, health, law, engineering, accounting, architecture. So it's funny, so this list actually was used for the qualified business income deduction. So, and when they did it for that, they said, well, we're going to let engineers and architects get a pass, even though they're bad businesses for purposes of 1202, they're good businesses for the purposes of the 199A deduction. So Marty, what did you reinvent yourself to be?
For 199A, I'm a trust architect.
There you go. So Marty is an architect, so he gets the 199A deduction. So, of course, he's saying that tongue in cheek. He's not really saying it, but we just want to know that all of us on this call, in terms of both 199A and 1202, we are all doing evil businesses. We are doing Satan's work. Our stock in our service corporation, if we have one, doesn't qualify because we're not doing God's work. And look at this. This says doctors too, health law. They're saving people's life, yet they're not doing God's work. I don't quite understand that. But here's our list of excluded areas. Let's go on to slide 22. Here's some other excluded businesses. Banking, insurance, financing, farming, timber, operating hotels, motels, a bunch of stuff are not qualified businesses. So when people say the 1202 exclusion is the greatest tax shelter there is, your business might not even qualify. Let's go on to slide 23. You can't have more than 10% of the value of your assets be in real estate unless that real estate is used in the active conduct of the business. And even if you lease that office building to a third party and you're doing an actively leasing that does not count as the active conduct of a business. Remember, the prior slide said that leasing is evil. But the bottom line is, your real estate really should not be inside your C Corp anyway, for other reasons. So I just keep real estate outside the C Corp to begin with. But again, there's restrictions. Slide 24. The business cannot be a former S corporation. So if you're an S corporation and you say, hey, 2017 tax reform makes C corporations a lot more attractive, let me revoke my S election so I can be a C Corp and get the lower rates. Well, if you do that, that C corporation stock is not going to qualify for Code Section 1202 exclusion. However, there is something else that you can do. Instead of that, the S corporation could transfer all of its assets into a new subsidiary it forms, a new C corporation that it forms. So when the C corporation gets all of those assets, now it's a new corporation. The 5-year period measures from the time that the C corporation is formed, so you can't count the time that it was an S corp, but now you have a C corp. And an S corporation that sells 1202 stock, the exclusion counts, and the exclusion benefits its shareholders. So that does work. Now, the corporate formation can be taxable if liabilities exceed basis, and there's some detailed rules on that. And I'm not going to spend time going into those. I do like using a corporate reorganization to form a C Corp, but that does require keeping their zero tax ID, and I wouldn't recommend that, because if you sell the stock and the IRS looks under the tax ID and it says, oh, this tax ID belonged to a C Corp and an S Corp, then they might take the position, oh, this is a former S Corp. So I would actually do the asset transfer. Okay, slide 25, business structure subsidiaries. If you have a C Corp subsidiary, then you disregard the C Corp subsidiary and you can look through to its assets. Slide 26, suppose you have 49% ownership. So then it doesn't count as a subsidiary, because on slide 25 I mentioned it has to be more than 50%. So you have 49% ownership. So now your 49% subsidiary doesn't count as a subsidiary. It just counts as you're holding stock. Stock is not a business asset, so that would be a disqualified asset. And if you hold more than 10% of your business assets as non-business assets, then you lose your qualification for 1202. Now, what about if you have a C Corp and it has a single member LLC as a subsidiary? We know that single member LLCs are disregarded for income tax purposes generally. However, the check the box rules do say that if disregarding the entity is fundamentally inconsistent with some ingrained principle in tax law, then you don't disregard the entity. Is this fundamentally ingrained? This 1202, not being able to own a passive asset like that, not to be able to own something other than a C Corp subsidiary, is that ingrained? I don't know the answer to that. I think that a single member LLC may qualify, but I wouldn't take any chances. I would just have a C Corporation subsidiary instead of a single member LLC. And you're allowed to, basically, if you have a C Corporation subsidiary, you can file a consolidated return and ignore that subsidiary as a separate entity for your federal income tax purposes. So there's no reason that I would do a single member LLC. I would do the C Corp subsidiary, and you own 100%, you're all good. Slide 27. Let's go back and take another look at that $10 million limit. So that $10 million limit applies to each C Corporation you own. What if you had multiple C Corporations? So I have my restaurant chain in St. Louis. I decide that since I like Marty so much, and Marty came to my restaurant, he loved my food, and he said, Steve, if you open one up in New Jersey in my neighborhood, I can guarantee you I'm going to send all my friends there. It's going to be a smashing success. So at that point, I have two choices. I could take my C Corp, and I could simply open up another branch, another location there in New Jersey. That's one option. Another option is I could form a brand new C Corporation and start a new restaurant there. So if I did that, then I could get the 1202 exclusion for my St. Louis restaurant and for my New Jersey restaurant. Because restaurants are good businesses. Lawyers and accountants, we are bad businesses. I'm doing my restaurant business, so I'm okay. So I'll get two $10 million exclusions if I have a separate C Corp. However, if I take money from my C Corp in St. Louis and I distribute it to myself, and then I contribute that to my C Corp in New Jersey, then I have a taxable dividend to myself, and I have a double taxation. Now, my business in St. Louis could loan money to the business in New Jersey if that's a true loan and it's expected to be repaid, etc. So we may be able to do the job through loans, but you need to have a practical expectation of repayment, etc. I actually have some other slides on loans later on. But the bottom line is that if I had my C corporation in St. Louis and I simply opened a branch in New Jersey, and that branch is just part of my one single C Corp that operates both locations, so now all the money is under one C Corp umbrella, I don't have to worry about loaning money to the New Jersey branch. I'm simply doing it, we're all in one happy family as a C Corp. Also, most businesses have losses in their first year or two. So if my restaurant in New Jersey had a loss in the first year, if that's set up as a separate C corporation, I can't use it to offset the income I earn from my St. Louis C Corp. But if my New Jersey operations were a separate branch, but all under the same C Corp, then my losses from my New Jersey operation could offset my losses from St. Louis. So you may want to do the brother sister C Corps, but just there are some disadvantages. So as a practical matter, do you expect both restaurants to combined have a value in excess of $10 million at some point? If you don't think it's ever going to get that high, then just keep it under one C Corp. But if you think they may take off and explode, then maybe you do the multiple C Corps, knowing you have these disadvantages. Let's go on to slide 28. Here's another option. I kind of mentioned this before about when I said if you have lots of cash you're raising, rather than worrying about whether you're within this 2-year period or not, start as an LLC and then convert to being a C Corp, because you can do that generally on a tax-free basis. Well, you may want to just start off as a partnership and convert that to a C Corp later. And if you have a partnership and you have startup losses, you're allowed to deduct those losses up front. Now, if I'm making a lot of money in my other businesses and I have a startup loss and I can take my loss against that business income, that's a wonderful benefit. But what if I quit my daytime job and I have no income, and in the first year I have a loss? Well, that loss isn't going to do me much good because I don't really have anything I'm offsetting with it. So I would rather probably not even deduct that loss in the first year. So I might want to be a C Corp to begin with, so I can take my C Corp loss and just carry it forward to the next year. So another advantage of starting off as an LLC, let's suppose that my company grows in value very quickly to be worth $5 million. Then I convert it to a C Corp. And then after waiting 5 years after the conversion, I sell my stock for $50 million. What is the consequence of that? So the consequence is that I can exclude from income much more than $10 million. Now, if I had done this from scratch when I had almost nothing in the business, I'd have a $10 million limitation. But because I converted this when my business was worth $5 million, I can take the 10 times basis limitation and I can have an exclusion of as much as $50 million perhaps, because that's 10 times the $5 million. Now, I didn't make a distinction here between, I said my business was worth $5 million. Was that my basis, or was that just the value of the business? So here's the weird thing about the statute. The statute says that when I'm contributing property to the C Corp, I can count the value as if it were the basis. So let's suppose my LLC is worth $5 million when I do the conversion, and let's suppose that I didn't really accumulate any cash inside. That happens, that $5 million is all goodwill. I still get to take the fair market value of that $5 million and multiply it by 10 to get a potential exclusion of $50 million. However, the other thing the statute says is that we're not going to give you that exclusion for any built-in gain at the time of conversion. So in my example, I had a zero basis at the time of conversion and a $5 million value. That $5 million appreciation does not qualify for 1202 stock treatment. So if I sold my business for $50 million, I might have a $50 million exclusion, but I cannot use that on the first $5 million because that was my built-in gain at the time I formed my C Corp. So I actually have a $45 million exclusion at that point. Now, let's suppose my business grew to $55 million. Well, I have a $55 million gain. $5 million of that was built-in gain, so that's ineligible for the exclusion, but I have a $50 million difference that is eligible. So I'd be able to use the full $50 million exclusion on that. Okay, so that's some nuances there. Slide 29. So you do get this extra gain on sale. You do have to count the built-in gain. Now let's go back to my example that I had before, and we had my business. It started with a zero value, and then I started it as a C Corp, and I sold it for $10 million. So I get a $10 million exclusion. What if I start it as a partnership? It grows to $5 million. I make my C Corp election, and then I sell it 5 years later after making the C Corp election. So all of my post-appreciation growth will receive that exclusion. So the increase from 5 to 10 million, that $5 million does get the exclusion, but the $5 million built-in gain does not get the exclusion. So here's the gamble that we took. If the business grows to only $10 million, I'm better off starting off as a C Corp because the whole $10 million gets the exclusion. Whereas if I had converted halfway through, then part of my gain does not get the exclusion because all my built-in gain at the time of conversion doesn't get it. But if I sell my business for lots and lots and lots, like $50 million bucks, then I get a big benefit from having waited to convert. So anyway, that might be a little bit confusing. I do have examples in my materials. So I just commend you to go and look at the examples. They will work through all these numbers. Slide 30, there's some other ideas when selling C Corp stock on trying to avoid capital gain. There's some also relating to losses. I'm not going to get into those. They're in the materials. You can go take a look at them. Slide 31, the gain on the sale. Focusing on this exclusion is one-dimensional. because it assumes that you're going to be selling your stock. Now, a lot of times you do sell stock, but let's look at the buyer's perspective. Suppose the buyer is paying $50 million for my stock, and my company has inside of it assets that have been fully depreciated, so there's zero basis there. So my corporation has run out of depreciation deductions. It has no depreciation deductions. So my buyer is buying $50 million for that stock, and yet, and that $50 million is reflected in the value of the assets in the corporation. They really, from the buyer's viewpoint, they don't really care about the stock. They care about the underlying business. They're paying $50 million for the underlying business, but they're not going to get any depreciation deductions because those assets inside the C Corp have zero basis. So they're paying $50 million for a $50 million business, but they're getting no depreciation, no goodwill amortization. The buyer is not too happy about it. What a buyer really likes to do is to require a deemed asset sale. So under, you see on the second bullet point, I refer to a Code Section 338H10 election. And what that says is that when the buyer buys a stock, we will treat it as if the buyer bought all of the assets and the corporation immediately liquidated after that. So if you have your 1202 exclusion, the redemption part may be protected from the exclusion. I mean, that depends again. Is it $10 million? Whatever the multiple basis, all those other things we just went over. You may protect all of your gain on the redemption, or it might not protect all of your gain. And by the way, our firm has an office in Los Angeles, California. California does not recognize the federal exclusion for 1202. So my California clients would have a federal exclusion, but California would tax them on that capital gain. Now, what else happens here when we have this 338 election? Okay, so we have our redemption of the stock, and we also have our sale of the asset. So the C corporation is going to pay tax on the sale of the assets, and that's going to come out of the seller's hide. But the buyer is going to insist on the seller taking, paying that tax or taking a reduced purchase price from that. So there will be a tax on the sale of the asset. Even if the 1202 exclusion totally protects the stock, there's going to be a tax on the deemed sale of the assets because the buyer is going to insist on that. And again, this is just very typical. There's not a requirement that the buyer do that, but if the buyer doesn't require the deemed sale, the buyer is going to say, hey, I'm not going to pay full price for those assets. I don't get my depreciation deductions. I'm going to knock off on the sale price. So even if that tax doesn't get paid, the buyer is going to pay less for the asset, and you will have the equivalent of having paid that tax because the buyer is mad about losing their depreciation deductions. And let's go to slide 32. Let's suppose you have an S corporation, and the S corporation gets sold. And again, the buyer insists on making this election. Okay, let's suppose I have my S corporation and I have zero basis in my stock, and the S corporation has $10 million worth of assets and zero basis, just to make things simple. So the S corporation's basis on its assets is zero. My basis in my S corporation stock is zero, and we're doing a $10 million sale. What's going to happen? The buyer is going to insist on the 338H10 election. There's a deemed sale of the assets. As the S corporation owner, I'm going to get a K1 for $10 million of gain on the sale of my assets. What happens when I sell my stock for $10 million? Well, that $10 million gain on my K1, I'm going to get basis in my stock for that. So now I have $10 million basis in my stock. I have a $10 million gain on, I have a $10 million proceeds. What's my gain on sale? My gain on sale is 0. So let's go and compare the gain on my sale if I'm in California. If I'm on California and I have an S Corp, I have 0 gain on my sale for federal and state income tax purposes. If I have the C Corp and I have 1202 stock, I might have 0 gain on the sale for federal purposes, but I've got $10 million gain on the sale for California purposes, and I may wind up paying $1.3 million in capital gain in California capital gain tax. So if I'm in California, I actually pay more tax if it's 1202 stock than if it's an S corporation, at least on the gain on my sale. But I want to get that nuance through to you. S corporation shareholders generally will not be paying capital gain tax when they sell their S corporation stock. They will not be paying tax on that stock. They don't have to worry about whether it's a qualified business, whether they held it for 5 years, what kind of asset test, what kind of business structure they had underneath it. You don't have to worry about all of those 1202 requirements. You get a full exclusion on the gain of your stock. That can be better than 1202. Now, that's not the full story. As my friend Richard Robinson in Denver would tell you. When you have the deemed asset sale by the S corporation, those assets are going to be sold and taxed at the individual's income tax rates. What are those rates? Well, if you have depreciation recapture or some amortization recapture, that's going to be taxed at the highest bracket, which is 37%. You might get a 20% deduction for that as qualified business income if the sale occurs before 2025. But it's not at all assured that you're going to get that 20% deduction under Code Section 199A, because there are limitations to that deduction that are beyond the scope of my presentation. So you're looking at anywhere between 29.6 and 37% for the tax rate on that. And if you have a capital gain on the sale of those assets, that's going to be 20% federal plus 3.8% net investment income tax, or 23.8. Compare those rates to a C corporation's federal rate of 21%. So the C corporation gain on the sale of the assets is smaller than the S corps. So you really have to compare them. Now, I don't know how long the corporate income tax rates will be 21%. We don't know what tax rates are. You know, we know what they are right now, but we don't know what they're going to be tomorrow. And, you know, people are talking about, you know, what if the Democrats get in power, then there may be, you know, a tax hike. But you know what? We have $1 trillion plus budget deficit. We have Social Security, the trust fund is running out of money. Medicare is running out of money. There's going to be a huge need for revenue. And even if the Republicans stay in office, eventually those situations are gonna come to pass. How are we gonna raise the revenue? I don't know how they're gonna raise the revenue, but I'd like to harken back to the Tax Reform Act of 1986. The top individual rate then was 28%. And without any tax law at all being passed, it was called tax reform between 1986 and until we had 2017 tax reform. The top rate crept up to, if you count the net investment income tax, over 43%. From 28% up to 43%. If you do the math, that's over a 50% tax increase. The rates just crept up over time without anything called tax reform. They crept up over time. And if that doesn't convince you that Congress is creepy, then I don't know what will. But we just cannot count on our tax laws staying the same. So I'm not sure what this is going to be and that going down the road. Let's go on to slide 33. So I go into talking about S Corps versus C Corps and annual distributions. I do have a January 30th, 2018 webinar where I went over those, and I'm happy to send those to you, or you can eventually find them. Let's go on. So slide 34 starts a presentation about the seller finance sale of goodwill, and I'm going to skip over to slide 39. So keep Marty's fingers. He did that so quickly. He did a great job. If you have a partnership, so first of all, when you sell your partnership interest to the buyer, you ordinarily would pay capital gain tax on that, but the buyer can make an election called a 754 election, and they can get an inside basis step up in the assets. So with a partnership, you have a benefit, and the partnership is very likely when you go and sell your partnership interest, you may get capital gain treatment for all or most of your gain on the sale of your partnership interest. Contrast that to the S Corp that might have lots of depreciable property that you might have more ordinary income. So partnership does have a better deal when you sell that. Another option for a partnership is if you have a service partnership or just any kind of a partnership where it's not capital intensive. So, I mean, maybe you're a startup IT group and all you have computers, but that's not really the big part of it. The big part of it is just all of your time invested in writing the source code and getting everything figured out. So all of that can be something where you can have a seller finance buyout, and the seller finance buyout, what you can do is you can tax the earnings to the seller. And instead of what is normally with a buyout, the earnings are taxed to the buyer and the seller pays capital gain tax. If you ran through, and I don't have time to go through all of it, but if you ran through all of slide 34 through slide 41, I get into the idea that you have double taxation with an S Corp in terms of the buyer having to pay tax on the earnings and the seller paying capital gain tax. With a partnership, you can just have one layer of tax, meaning the earnings on the business are all that gets taxed. And then you have to gross up the seller for that. I don't have time to get into that. If we skip on several slides down to slide 52, I have intra-family sales. There was an important case called Dynamo Holdings on this case. I did a webinar on that a lot earlier, but basically it talked about intra-family sale of stock and it also talked about intra-family loans. I have a bunch of slides that go through that. They compare it to another case, and an intra-family sale of stock wound up being a constructive dividend in there, and that kind of goes through all the way through slide all right, through slide 68 or 67. And anyway, and then starting on slide 67, I talk about intra-family loans. And here they had some defects in documentation, namely they didn't have timely notes. And as you go through the case, you can see what factors they were able to use to prove their case that these were legitimate debts. And so if you do have somebody who hasn't documented their stuff properly, number one, go and get them to document it. But number two, go and dig up a bunch of facts, see if you can try to make it be like this Dynamo Holdings case. Now let's go on to slide 76. And I encourage you to get, I have my materials. The materials you download, again, Marty mentioned that I have, 100-something pages of materials these are excerpted from over 2,100 pages of business structuring materials that you can get free. And I am going to send, a few days after this webinar, I'm going to send out an email to all of you asking you if you want the full materials, then you can get a PDF of over 2,100 pages of business structuring materials. You can also sign up for my quarterly newsletter that gives you the most recent version of those 2,100 pages of materials. I have quarterly webinars where I present their free webinars. About 4 weeks after I do my newsletter, I will present a webinar that talks about 3 different articles, an oral presentation of articles from my newsletter, and those are offered. They're free CLE credits in some jurisdictions. So, but you can email me. I mean, you've got the cover slide of this. My first slide, which is slide 8, has all my contact information. You don't have to wait for the email. Go ahead and log in and email me. I'm happy to give those to you.
Steve, I want to thank you. Do you want to say anything else to wrap up, and then we'll close?
Yeah, I'm going to wrap up. So 1202 does have some. It has a lot of pitfalls in it. You have to be very careful if you're going to work on it. And it reminds me of somebody who's skydiving for the first time. When they're skydiving, they're trying to open up their parachute. They try. They can't. They see somebody shooting up from the ground, and the guy who's skydiving says, "Do you know anything about parachutes?" And the guy who's shooting up from the ground says, "No. Do you know anything about gas stoves?" And the idea here is that the tax laws can blow up in your face. If you are going to look at 1202, look at all of the pitfalls and all the qualifications. Think of all of your alternatives and think about using some kind of a pass-through. So that's it for now, and I'm going to turn it over to Marty.
Steve, I want to thank you for the program and thank our sponsors, Peak Trust, Interactive Legal, and the American Brain Foundation. The materials we posted to schenkmanlaw.com/webinars within a few days, and a recording of the webinar. And Steve, I thank you. It was really very informative. So often the 1202 discussions I've heard people present are just, the excited version of, wow, you can do everything with 1202. And I think it was very great to get some of the balanced technicalities that people need to be cautious about. Thank you all for joining us. Take care.